Hello and welcome to BQ Prime. You're joining us on a latest episode of Bankable, where we discuss with some of financial services industry's biggest leaders on how they're seeing the current market evolving, the business environment shaping up, some of the opportunities that they see coming up for their businesses, as well as the challenges that they want to overcome. To discuss this further, I have with us Mr. Ramesh Iyer, Vice Chairman and Managing Director of Mahindra Finance. Mr. Iyer, welcome to this conversation. I want to start this chat with something that an analyst has noted in a recent report about your company, is that this is a credible turnaround story, but execution is still key. I wanted to get a view on this turnaround story that is happening at Mahindra Finance. You had a tough couple of years, especially with COVID playing problem with your borrower base. But since then, things have consistently been improving. So if you can just take us through what has changed at Mahindra Finance so far.
So this is a 30-year-old model, right? And we've always chosen to be in the semi-urban rural market. We have chosen certain segments of customers who are self-employed, traders, farmers, contractors, and that's a segment we worked with. We built a very strong retail channel, close to about 1,400 branches, have people locally recruited who understands the market well. That's where this business was built around. You're right, when we went through the disruption due to COVID, this segment of customers were the worst hit. And in that particular quarter of the second wave, in fact, we booked our highest losses and our provisions went up, or our gross stage 3 went up to about 15%. We had even said then that the customers are there, the assets are there, things have to change on the ground for things to improve. So that's the first turnaround. If you look at, things have really improved. The economic activity has picked up, whether it's the tourism, whether the contracting segment, all of that is doing well. So therefore, the customers are doing well on their own. Second is, when we went through those disruptions, clearly we kind of identified as to which geography, which product, which segment of customer is having the highest stress. It's very important in this market or in this kind of segment that we partner the customer and don't take extreme actions, imagining them to be a failure of default.
Right.
They would bounce back.
Right.
So we took a partnership approach, and then of course there was great support that was available from the Reserve Bank as well as from the government in terms of moratorium, in terms of restructuring. We did provide them to the customers. But even more important, I think we resorted to a more closer follow-up and agreeing to collect in a month, maybe more than once or twice. So if somebody is not able to pay all the installment at a time, if they were to pay it on a weekly basis, we did resort to even those kind of collections. All of this helped that customer to come out of their difficult situation, and we saw a turnaround there very clearly, where the gross stage 3 has now come down from 15% to sub 4% in a period of less than 12 months to 15 months. So that's one big shift that's happened. I think second is, there was an enormous focus on ensuring that the customer forward flow does not happen from stage 1, stage 2 to going to stage 3. So that's the other block that got created. The entire allocation of customer contracts to various employees, their compensation around that, all of that were restructured in a manner where the focus substantially improves. This is from a past book. And as far as the new book underwriting is concerned, we did use various rule engines based on these historic experiences and brought in certain norms which would filter some of the customers to be not eligible to become those kind of credit. And therefore, if you look at our new book, they are behaving extremely high quality. And therefore, they are at sub 1% kind of an NPA, 2% kind of an NPA in different geography. And therefore, the future book that we are building is of a very different quality.
Okay. But how long does it take for this book to sort of replenish itself and become mostly new?
So typically, we have a 30 months book.
Right.
And when we did face all the disruption, the book would have run already 10, 12 months, 15 months. So there are different stages. But I would imagine that, let's take pre-21 book will kind of go out in somewhere in 25.
Okay.
And therefore, by the time as we built a book, then you'll see a new quality book.
Roughly 2.5, 3 years.
That's right.
Is where it takes. Okay. I want to touch a little bit upon the customer base and the kind of recoveries that you've seen. But before that, transformation is also happening in terms of a technological transformation that you've undertaken. You have a 2025 sort of vision that is being implemented. What is it that has led to this technological sort of transformation to be taken up as a campaign? The reason I'm asking that is because tech evolution is something that happens across all institutions. So what is the reason for this to have been such a big part of your transformation story?
So again, go back to where were we working and what's the readiness of the customer.
Okay.
Right. So it first comes from the readiness of the customer to be able to use all of this. Right. Second is what's the overall ecosystem support that you get.
Yeah.
Right. Earlier, many of our customers were not even in CIBIL. They didn't have a score. Now that many of these customers also have a score, we are able to use this data and use the underwriting from a very different perspective. Many of these customers were cash paying customer. I mean, we had a stage where more than 90% of our customers were paying in cash. When we look at it today, just about 35-40% of the customers are paying cash, which means another 60% of them have moved to paying through various electronic means. So if you fundamentally look at it, the change is always caused by the need of a customer.
Okay.
It's not our requirement that we want to invest in technology. It's a need of the customer. So you give them better facilities, give them better experience, give them more methods and means to repay, and therefore all these investments.
Fair enough. I want to touch a little bit about the one thing that you pointed out in your first answer, which was that you broke up the repayment cycle according to the customer's needs. If somebody can't pay in one go, split it up into 4, do a weekly payment. That's a very microfinance inspired sort of repayment strategy. I'm trying to understand, because your business is not microfinance. You're not dealing in that, right? You're dealing with small businessmen, small entrepreneurs who will probably need commercial vehicles or other business loans to develop. This marrying of microfinance or a small value loan dispersal strategy with slightly bigger loan accounts. How has this come about? Because this is not just Mahindra Finance. I'm seeing this across other companies as well. Everybody's been sort of implementing this strategy. How has this marriage happened?
So I think it's fundamentally to understand we are not giving them a weekly payment for their just 1 month installment.
Yeah.
They are all customers who are built over dues.
Yeah.
And they need therefore that kind of a time to be able to pay for the past dues. That is what they are taking, certain part payments on a weekly basis. In a month, are they able to pay their full installment at a time? The answer is still yes. But if they already have 2 more installments to be paid, can they pay us 2 installments, 3 installments on the same date? The answer is no. And that's how it gets split. So it's not that 1 installment is split into 4 weeks. It is a 2 installments or 2.5 installments outstanding is split into 4 weeks. So typically per week or a 10-day collection would be like a 50% of the installment.
Understood. Okay, fair enough. Coming to your business now, you've established yourself as a commercial vehicle, well, largely tractor financing business, right? And that was the original business that Mahindra Finance did. You also developed the other segments in your portfolio. You're looking at unsecured credit. I want to understand the evolution of thought behind how your loan book should look like.
So as far as the book is concerned, I think we'll still be very heavy on vehicle tractor as a book, because we currently have about 85,000, 86,000 crore book, which is upward of 95% is still vehicle and tractor. Is that going to run away? The answer is no. Look at the year 2025, when we talk of lakh and 25,000 crore kind of a book number, we still believe that about 20% may come probably from, or 15-20% will come from non-vehicle. So therefore, it will still be very vehicle heavy, tractor heavy. Now, as far as the need for other financing comes from, again, ask of a customer. Like until such time, we were able to understand as to where else and what else they borrow for.
Right.
We were restricting ourselves to this.
Right.
When we look at now, many of our customers, they do take personal loans, they do take consumer durable loans.
Yeah.
They do take it from other sources. Therefore, the fundamental question that we had to ourselves was, can we design a product and deliver this to our existing customer?
Yeah.
Right. So therefore, our unsecured loan book will first be built through our existing customer. Once we test it out, understand that well, deliver it against the ask, then we'll broad base it to even non-Mahindra Finance customer going forward. In as far as other than vehicle and unsecured loan concerned is the SME piece. We were into SME financing, maybe even 4-5 years back. We had built a book about 5,000-7,000 crore.
Yeah.
I think the market conditions did go through a difficult time, and therefore we kind of went slow on that. That's where we are coming back, and very clearly we are looked at auto engineering and agri as the 3 industry vertical where we want to participate. And therefore it's not something new, but definitely it's something as a grow forward, growth story for us.
Yeah.
And clearly we think as we reach 2025, we should be about 15% of the book coming from non-vehicle.
When it comes to core principles of lending to the segment, right? The segment that you're in, for whatever reason, they might be a small borrower, but they reflect the sort of economic mood of the country as well, right? Whether the rural parts of India or semi-urban parts of India are doing well or not is key to how the overall country is doing. To your mind, what has that evolution? Well, let's take COVID out of the equation, but over the last 10 or 15 years, what does that evolution look like?
So clearly, this market looks at 3 or 4 cash flows. One, it looks at the farm cash flow. It looks at the tourism as one important element. General people movement is the other they look at. Then the contracting segment of the cash flow is what they look at. If you currently you look at it, I think all of these are doing extremely well. Right? So therefore, all the 4 cash flows which drive this market is doing pretty well. Minus COVID, you're right, is the time where we had a maximum pressure because none of this was doing well.
Correct.
But historically, if you look at, when contracting and the farm does well, the rural market does extremely well. And we are seeing that clearly happen. Right? So I don't think some basic fundamentals in rural as a cash flow has changed substantially. It's just the overall activity level from these 4 elements of cash flow that I talked of are doing extremely well. And that's driving the real growth. Now, for us, in addition to all of this, we have looked at certain high-end customers. We call them as prime customers. Something that we were not very actively participating in because they were very bank-like customers. And their ask of the lending rates were pretty low. Now, when we are into this segment of customers which are other than Primex, we've rediscussed with the various dealerships and we have said, if we are willing to participate here, why don't you give us a portion of that business? Now, therefore, the two together make sense. Otherwise, just as a Primex customer at a net interest margin level slightly lower may not make complete commercial sense to us. But when we look at it as a total, then it makes a phenomenal sense to us. So therefore, that's a new segment that has come to us in the vehicle business. And that brings, while at the net interest margin level, it just shrink a little, but cost of operation and the credit cost for those customers are so low that at an ROA level, we still cover up.
Okay. So it is a very profitable business for you as such then. Okay. But prime customers, as you said, they are bank-like customers. So there is a competition element to this as well. How is the banking competition looking like for you? Because I don't see any other NBFC being quite as close as to how far your business has expanded. But banks, definitely the competition.
Yes, of course, banks are definitely there. But again, what is the ask of those customers as well? Right? I think a faster decision to lend, right? 2, a partnership approach. And 3 is to be able to meet their requirement. Now, definitely even the banks can meet and even we can meet. But there is still an element of dealership decision as to when they are the prime seller of the vehicle, they do have some say in how do the business gets diverted to different entities. Now, what we have done typically is we have a large customer base. And just to give you a number, we operate in 400,000 villages of this country. And we have therefore something like 6-7 million customers that we have worked with. We have created a direct marketing vertical. What this vertical does is to reach out to our existing customer and through them source more business. So in a month, we see about 15 to 18% of the business that we do is self-generated. Now, this is the business that we bring to dealership. And we make a huge strategic difference at a dealership when someone as a financier can bring business. And I think that's a value proposition on which we sign up with the dealer. And therefore, there is a natural advantage to get these kind of customers, while we have to be as efficient as any other provider of credit, both in terms of rate and in terms of service, right? And if you're able to do that well, then I think the opportunity is still there.
Okay. I'll touch upon the regulatory environment a little bit. So, with NBFCs such as yourself, there is a differentiated sort of regulatory framework that the RBI has introduced. Large NBFCs such as yourself occupy that top layer, and they get regulated in a way which is akin to banks. At least that's what the regulator says. I'm curious to understand: does that significantly increase your burden, or were you already doing a lot of what the RBI is already asking?
So, almost all these regulations are coexisting regulations. They get little more tighter and they get monitored even more closely. Now, our belief has always been the higher the tightness of the regulation, stronger the model emerges. It's always very difficult to accept and implement immediately. I mean, let's take NPA as just one item to discuss. when I started this business, I remember the NPA was 365 days now. Then it moved to 180 day now. It moved to 90 day now, right? Now daily stamping is required. Now, did it not build pressure on the organizations? The answer is clear, yes. Because ultimately, it's not about us bringing about the change in the method of calculating it. It's about convincing the customer to accept the new approach.
Right.
So therefore, it takes a little time. But once it's got accepted, then you look at the quality of book because of that. It substantially changes. So regulations will come, regulations will get tighter. I think all of us have to look at our business models and see how do we factor this regulation into it. We have to look at the segment of customer and ask a question, how do we communicate and convince the customer around it? We have to look at our internal process and see what kind of training we need to implement so that everyone understands it the right way. And lastly, we'll have to look at how much of it we'll continue to do in a physical environment versus how much of it can be controlled through technology interventions. And thirdly, how much of it can be really outsourced and controlled rather than doing it all in-house. I think that's the evolution, and I think regulations are here to stay and will become more tighter, but the models would get stronger.
You mentioned at the beginning that this is a 30-year-old model, right? The NBFC as a business model. What is the premium at this stage? I'll supplement this question with, we've seen this large housing finance company merge with a bank that it started, right? They said, one of the pointers that they mentioned during the merger was that the arbitrage is gone for us to maintain a bank and an NBFC. Of course, your group doesn't have a bank, but is there still business sense in continuing to be an NBFC with the regulations being so tight?
I mean, we have had a 27% CAGR from the time we started to today. If you look at our March closing numbers, we had a 50% plus growth. Look at our first quarter, we still have a growth of 40-50%. I think, is there still headroom? My answer is yes.
Okay.
Because NBFCs are designed to deliver for vehicle financing as a primary product. Historically, if you look at it. Having done that well, is there an opportunity to do other products to your customers and like your customers? We just discussed about our unsecured loan, SME segments, etc. I think I would think there is a phenomenal role there. You have to differentiate yourself from the other providers. Either be closer to customer, go more deeper, right? Understand needs of the customer, design products around that, right? And three is partner the customer in difficult times and provide them solution, and maintain a book in a manner that you are rated well. So we enjoy a AAA rating. So therefore, we have an advantage in terms of our ability to source ourselves enough funds at an appropriate price.
Understood.
And therefore, there is, I would think that there is sufficient headroom left.
Okay, fair enough. Coming to the business aspects of it now, into your view, lending to the segment, what is the biggest opportunity, let's say 5 years in advance, 5 years ahead of us at this point in time? Now we are in 2023, let's say 2028. What do you think is going to come up as the segment that probably everybody should be watching out for as a growth opportunity?
So I think first and foremost, I would think is that credit is becoming very, very formal for every customer.
Correct.
Right? There was a large credit informally going to one segment of customer. I think that will start shrinking, which would mean that the customer base eligible for credit will keep widening.
Right.
Now, once that happens, you will find the credit growth naturally happens. Two, I guess, is we've always been talking about age of our population is much younger. And therefore, the younger population is more aspirational into experimenting as well as getting into new avenues of possibility. Right? So therefore, there will be many opportunities, like maybe an education loan will become one of the biggest market of future. Housing will become even beyond urban and semi-urban. Rural housing will become one of the biggest opportunity. I think entrepreneurs growing their business to different size. We talk about India manufacturing, so SME segment will become a very, very big segment going forward. I think all of these are segments which one has to watch for, and they will open up phenomenally.
Okay. Touch a little bit about the recovery side of the story. Now, there was an instance that happened a few months ago, I think about a year ago, where Mahindra Finance's name was pulled up. What should a lender do in a situation when repossession, that's one part of the recovery story. Repossession is the only option, and there is a legitimate opposition from the borrower for that repossession. How should a lender handle this? Because there is a legal provision, sure, but on ground things don't actually pan out the way you want them to.
So, historically, again, if you look at this business,
Yeah.
when someone becomes a chronic defaulter, you have to look for, at the local level, who are the
Yeah.
opinion makers and how do you reach them out?
Yeah.
And how do you convince them of what's happening? Because today, because there are few defaulters in a village, nobody in the village wants that you stop lending.
Correct.
Right? And this message has to go down very clearly to everyone out there. While we know there will be some failures. So the first thing that even as a financier we have to do, I guess, very surely, is differentiate between intentional defaulter and circumstantial defaulter. And we can't deal with both of them in a similar manner.
Correct.
So circumstantial defaulter will have to have a partnership approach and then give solutions and come out of the trouble. So far as intentional defaulters are concerned, I think we shouldn't spend too much time trying to do it all by ourselves. We should press the legal button as quickly and as early as possible.
Okay.
Reach out to the local opinion makers and convince them as to why this is not as a good thing and therefore what kind of support are we required. But fundamentally, I think none of us as financiers should try and do things which are not regulatory framework allowed. So we have to take every step which is the right step to do. Involve the local administration. I mean, I don't think there were practices of informing the police well in advance to seek their help for such chronic default settlement. Like you said, on the ground, impulsive decisions sometimes get taken. I think that maturity needs to come in, and which means there is a continuous need for education and training of people on ground and a good supervisory layer about that to make sure things are done the right way. But since you touched on the incident of a year back, it was very unfortunate that we got dragged into it and then finally legally got sorted out.
Correct.
To say that we were not involved in it. Right. And therefore, these things do happen sometimes. And if you're unfortunately, at that time there, you may get dragged into it. But there is always a lessons that needs to be learned out of all of this.
Fair enough, sir. Let me also touch a little bit about the intention of the borrower. Now, you said that circumstantial borrowers and a chronic borrower, somebody who's intentionally sort of defaulting, they need to be treated differently. But India's financial system is built on this belief that everybody wants to repay money. Nobody really actually wants to take the banks or the NBFCs for a ride. With the increasing debt levels, right, and new to formal financial system borrowers coming in, has that changed at all, or do you still hold on to that belief that everybody in India actually is afraid of holding on to debt for too long and they want to repay as soon as possible?
So I have seen that 95% of the people who borrow repay very regularly. 90% on or before due date, another 5% on a little follow. The problem is with the last 5%. Now, this last 5% has all kinds of combination. It has combinations of even sometimes wrong lending.
Okay.
Right? You're in a hurry to lend, you overlook some document, you overlook some input, and you end up giving to a wrong person. There are also certain over-aspirational individuals in that last 5% who want to experiment getting into some business because there is a debt available. I think those are the ones I keep calling them as, how to differentiate them between circumstantial and intentional. The fundamental to success of this business will always be not to breach on loan to asset value.
Okay.
At least on the retail front.
Okay.
If you have a customer margin money of at least 20%, 15 to 20%, chances that the customer will intentionally default will substantially go down because they put in their 50%.
Yeah.
That's not changing.
Skin in the game, essentially.
Yes, that's not changing.
Okay, fair enough. I want to pick on the last couple of questions for this conversation. One is your promoter has looked at a bank as a investment strategy. I know that it's very difficult to pin what the intention behind that is, but is banking even something that is worth pursuing for an industrial corporate?
So, we have said it several times in the past. As an excellent corporate, as a large financial services player, banking as an opportunity Have we looked at in the past? My answer is yes, we will look at it. We have looked at it and we'll continue to look at it.
Right.
So that doesn't take away anything from there.
Right.
You yourself said the regulatory framework today for industry houses is not allowing probably setting
Entry,
up of a
yeah.
bank, and therefore the regulatory framework has to change. Beyond that, the interest in the banking industry will always have to be there for large corporates.
Okay. Why? But what is so special about banking for a corporate?
I mean, that's the ultimate financial model.
Okay,
right?
fair enough. Fair enough. That's sort of the peak of the financial services business. Fair enough. Last question I wanted to ask you in terms of the challenges that are coming up in your business. I mean, asset quality is more or less now stable. Going ahead, because in a recent meeting, there were some news reports. I don't know if you want to comment on that or not. But the Reserve Bank of India seems to have pushed up vigilance on unsecured lending amongst NBFCs because they think that it's going on too fast. They've said this to banks as well. But do you think that is likely building up as a difficult sort of business in the future?
So, between secured and unsecured will always be a difficult business when credit cycles start to hit. The unsecured loans are expected to behave in a manner different from a secured loan, undoubtedly. But also it's important to understand that unsecured as a percentage to the total book of many of the NBFCs would be a very minuscule percentage.
Right.
Yes, some business models would have been built purely on unsecured.
Correct.
They would have different approach, different precautionary method, different credit assessment methods, different risk-taking ability, etc., etc. But if you're looking at an NBFC like us, let's say, even if we were to do 1,000 crore of unsecured lending on a 1 lakh crore book, it's hardly any percentage.
Correct, exactly.
Right? So therefore, I think one has to start differentiating it very, very, very independently. The focus is very high on unsecured loan because that's the fastest growing. But when you look at the fastest growth as a percentage is over a base, right?
Right.
And the base has been very low.
Very small.
So therefore, the percentage shouldn't kind of build any pressure. And the second thing is, as I said, mix of a balance sheet of any financial entity should be seen as to what percentage is unsecured. And if a larger percentage is unsecured, then how the whole business has been built to ensure that they perform adequately well is the way one should really approach it.
And what's your advice to the young upstarts in the fintech industry who are really chasing this business?
No, so I think my advice is, in fact, I met some of them even in one of the conference when I was addressing them. I think while you'll do everything right to lend right, you put in the right data, you put in the right technology, all of that is fine. But lending will always have equal weightage for recovery, right? So you must build capability within yourselves or partner with someone who has the capability that if there was to be a situation where recovery gets difficult, then you have an excellent fallback on who you can depend for that purpose. So don't build a model purely just on lending, imagining that everything is done right and therefore nobody will default. I think cycles will tell you that there will be defaults. So therefore build that capability or build that partnership.
All right, Mr. Iyer, thank you so much for joining us on this conversation.
Thank you.
Pleasure talking to you, sir.
Thank you.